Hi, Jared Sechel here. With me, I have Jose Arathun, Jordan Pearson, and Stephen Dennis. We are the team covering Stone Energy Corporation with the Brooklyn Road Institute at Tulane University's Freeman School of Business in New Orleans, Louisiana. Today, we will give you a rundown of Stone Energy, which is an oil and gas exploration and production company headquartered in Lafayette, Louisiana. We will provide a summary of Stone Energy and its strategy, followed by an industry context and 10K analysis. We will then describe our valuation techniques, investment summary, and our buy or sell suggestion. Let's get started. Stone Energy's market cap is around $1.5 billion, and the company has been expanding its operations since its inception in the 90s. Stone's PE ratio is about 16, and its most recent EPS is $2 per share. Stone's oil-to-gas ratio is about 44% oil and 56% gas, and the company is definitely moving in a more natural gas direction. Like all energy companies, Stone's revenues and profits depend heavily on oil and gas prices. Stone Energy has three main areas of operations: the Gulf of Mexico, Appalachia, and the Rocky Mountains, with the Rockies being in the developmental stage. In the Gulf of Mexico, Stone has significant oil and gas properties, both onshore and offshore, shallow water and deep water. Appalachia is a major play for Stone. It's completely natural gas, and if natural gas prices rise, Stone will see some major revenues from that area. Significant production should be underway this year. And in the Rockies, Stone has some promising oil plays, particularly in the Bakken Shale. They won't be producing for at least a few years, though. And because Stone Energy has become a more gas-oriented company, Appalachia will be the test case to see if that strategy is working. The energy industry faces some general risks. Obviously, prices determine almost everything. Oil prices are good right now for Stone, but gas prices are not good. Also, the oil and gas industry is heavily regulated by the federal government and state governments. Additionally, this industry is highly competitive. Every company needs to replace its reserves as quickly as possible. The deepwater drilling moratorium from the Gulf of Mexico disaster lifted several months ago, but the Interior Department has issued very few permits in the last year. This poses an obvious problem to Stone, and its profitability in the Gulf of Mexico is threatened by the possibility of a long-term permitorium.
Hello, Jose here. Let's talk about Stone Energy's income statement and balance sheet. 2010 was the first year since 2007 when Stone Energy made a profit. After going through the acquisition of Bois Energy and a major hurricane in 2008, the company reported net losses of $1.1 billion. These events left many investors worried about the company's liquidity. Since then, the company was able to reduce its losses to $218 million in 2009 and improve its financial position to create a net profit of $96 million in 2010. Stone Energy's net 2010 net income was a result of many factors. On one hand, management was able to cut costs by reducing its SG&A, interest expense, and lease operating expense. On the other hand, oil production represented a significant part of Stone Energy's profits. Stone Energy's financial health has been improving constantly since 2008, and our forecast shows that the company should report net income of about $125 million in 2010. Now let's talk about Stone Energy's balance sheet. As of March 31st, 2011, the company had $415 million of liquidity, which consisted of $113 million in cash and a bank credit facility with $302 million available. This puts Stone Energy in a comfortable position where if there were a significant oil or gas discovery during 2011, it would be able to finance the expenditures internally. Stone also replaced and increased its proved reserves in 2010 to a total of 474 BCFE from 411 BCFE in 2009. Now going to long-term debt. The company was able to repay $175 million of bank debt outstanding in 2010. It refinanced $200 million worth of senior notes at 6.75% due in 2014, and their total long-term debt comes to $575 million, including the newly issued $375 million of senior notes at 8.625% due in 2017. As you can see, Stone has been able to strengthen its balance sheet over the past years, and we believe that it will continue to do so.
Hi, Jordan here. I will describe evaluation methods and how we arrived at our one-year target price of $45. We use three enterprise value ratios, a DCF model, and a net asset value model to forecast Stone Energy's stock price. The first ratio, enterprise value to EBITDA, enables us to compare Stone Energy to its peers before the effects of capital structures on earnings. The enterprise value to EBITDA technique produces a target price of $46.99. The enterprise value to proved reserves method allows us to compare the company to its peers based on its tangible proved reserves and provided a price of $44.16. Using the enterprise value to daily production method, we forecasted a 12-month target price of $47.88. We calculated a target price of $44.54 using the discounted cash flow method, and we calculated, to do this, we calculated Stone Energy's unlevered free cash flow and then discounted the cash flows by the energy standard of 10%. The net asset value method produced a target price of $46.04, which we reached by individually valuing each property. Let's move on to the valuation football field for visual display of these target prices. The dotted line around $33 represents the price on April 5th, 2011, which is when this report was written, and the solid line above it represents our one-year target price for the stock of $45, which we arrived at by averaging the various methods' target prices.
Hey, Steven here. You just heard from Jordan about the different valuation methods that we use to evaluate Stone Energy. I'm now going to talk about our investment thesis. We believe that Stone Energy is a good buy at this time. As Jared mentioned earlier, Stone's management has been expanding the company's asset base. It is no longer simply a player in the Gulf of Mexico's conventional shelf, but now has many diverse plays. In our opinion, the Marcellus Shale properties will provide the company with cash flows to fund other projects. Stone's riskier projects, such as Deepwater and Deep Shelf, could pay off huge down the road. The company has good assets and is diversified enough to handle unexpected problems in any of their production regions. In addition to Stone's current properties, we believe that the company has enough liquidity that it will be able to take advantage of new opportunities if any present themselves. Stone increased its liquidity by over $150 million during the course of 2010. Our valuation suggests that Stone Energy's assets are being undervalued by the market, even after the recent run-up in its stock price. The potential threats that could slow the appreciation of Stone's stock price are prolonged low natural gas prices and government regulations. To summarize, we believe that Stone Energy has a strong and diversified asset base that is being undervalued by the market. It has the liquidity that it needs to take advantage of new exploration and drilling opportunities. However, investors should consider the aforementioned risks before investing. Despite these concerns, we believe that Stone Energy is a strong company with good management and is poised for success in the future. We have given Stone a market outperform rating and have a 12-month price target of $45. While we believe that Stone will outperform the market, Stone's beta is very high, so be aware of the risks that come with investing in a volatile stock. I hope that you have found our analysis of Stone Energy helpful. Thanks for listening, and we wish you good luck in the markets.
The material covered in this presentation is the opinion of the presenter and should not be construed as a recommendation to buy or sell any of the securities mentioned. Investors should seek the counsel of their financial advisor before making any kind of investment. The presenter may or may not hold long or short positions in any of the securities mentioned.